Refinancing a loan can mean a few different things. Essentially, what we're talking about with a refinance is perhaps extending the loan term. You might have 25 years left, and you're extending that back out to 30 years. Maybe you're accessing some equity in the property. You're refinancing the loan to finance additional funds to access some money towards something that you might need. When we are looking at capacity though to refinance, we've got to look at how much you're allowed to borrow based on current income, current expenses, and of course what equity you actually have in the property. If you're looking to access some of that equity, do you have enough for what you're looking to do? And so here we've got an example of what equity might look like in a property. You can see that we've got our home worth $800,000 and we've got an existing loan of $450,000. So you might say that the equity that we've got here is $350,000, which would take us all the way up to $800,000, the same value of the property. And that's true, that's how much equity you have in the property. But when a bank is lending money to you, they won't lend 100% of what the property is worth, because if the market starts to drop, they're overexposed. So the absolute maximum that banks will lend is 95% of what the property is worth. But more importantly, when you're refinancing, you want to avoid paying mortgage insurance. And that means that we can't go above 80% as a loan to value ratio here, 80%. So yes, we had a little bit more equity in the property, which we could access if we were to sell. But if we're just borrowing against the value, we're only able to access $190,000 without paying mortgage insurance. So it's really important to keep that in mind. Equity versus accessible equity. There are a few different benefits for refinancing a home loan. Typically what we see is the benefit of cash flow. People are trying to refinance their loan to reduce their minimum repayment. That could be via extending the loan term, could be consolidating debts, but in either way, they're looking to reduce their repayments and try and catch up a little bit. There are some downsides to extending loan terms and things like that, and we'll talk about that a little bit later when we go through the costs. But in terms of benefits, we'll run through that in a second when we're talking in particular about consolidating debt or just extending loan terms. The other side of refinancing or accessing equity in particular is putting that money towards another investment or another property. And so you can access equity in your current home to put towards the next home if you needed a deposit, or towards another investment. You can take equity and place that borrowed money towards another purchase. And so if we talk about this for a second, exactly like we did before, let's start with the debt consolidation side of things. Let's say that we've got $36,000 worth of debts that we want to consolidate. We've got plenty of equity, we're not up to 80% yet, so there's no concerns there. You'll notice that I set this up as a separate facility, which means if we wanted to look at our existing loan and we wanted to look at what debts we've merged into the home, we can still see them as two accounts. If we want to pay extra towards a debt and catch up on some of this consolidation, we know which accounts to pay down first. We know that we want to focus on paying down those smaller debts that we've merged into the one loan. Now, in terms of cash flow benefits, let's say that $36,000 is broken up into two accounts that we're trying to merge. We've got a personal loan of $10,000 at a very high rate, a car loan at a decent rate, but a short term remaining. So 3 years left on the car, 5 years left on the personal loan, and we've got just over $1,000 that we're paying out every single month. Maybe things have gotten a little bit tight and we just need to help out with cash flow. We need to consolidate these, reduce the repayment, and catch up on the debts a little bit down the track. We would merge that into one facility, extend the term from 5 and 3 years to 30. You can see the repayments drop to $220 per month. So we're looking at about $800 every single month that you've got back in your pocket to put towards other things if you needed to. Perfect world, we're going to use that same repayment, that $1,028, to continue towards these debts and just try and pay them off a little bit faster because we've reduced the interest rate on the personal loan in particular. Car loan's gone up a little bit, but overall we're saving interest. So what we look at here is the interest alone on these two facilities is $255 per month. The interest when it's merged at a lower rate is $184 per month. So we're looking at about $70 per month that we've saved in interest. And so that means that out of that repayment we had initially, we are putting $1,028 towards the same $36,000, but an extra $70 of this, which will continue to grow as the debt reduces, an extra $70 of that is going to pay down the principal, pay down the debt even faster. And that will just snowball to make sure that you can clear the debt faster than 3 years. So sometimes it's about cash flow, sometimes it's about clearing debt within a much faster period of time. Either way is absolutely acceptable when refinancing. If we were looking at the loan itself, let's put the debt consolidation to the side for a second and say that we're just refinancing this loan because we want a lower rate. A lower rate is definitely going to help with reducing repayments, and extending the term is as well. So what we've done here is a bit of both. But if we stretch this out just for a second, say that we're on the same interest rate, we've just pushed back the term, you can see that we've dropped the repayments by about $200 a month just by extending the term from 25 years to 30. Dropping that interest rate to 6.14 is going to save us again another about $100 per month. And so all of that additional cash flow can help reduce the loan even faster if we wanted to pay the same amount as before and just pay down more principal, or if we did just want to take the lower repayment for now and play a little bit of catch up later because we need cash now for a different purpose. So there's some benefits of refinancing. It reduces the repayment amount, but it can also reduce the interest rate, allowing you to use that same repayment to pay down your debts even faster. If we were looking at an equity release rather than just a lower rate or consolidating debts, but we just want money to put towards another purchase, for instance. We run with that scenario for a second. Let's say that we're purchasing an investment property and we're going to purchase for about $600,000, for argument's sake. Now, like before, we can't borrow the full $600,000 against the one property. We could put it against both properties and what we call cross-secure, but it can make things a little bit messy when we want to sell one of the properties down the track. So typically what we do is we borrow 80% of the purchased property against that property, and the balance, which is $120,000, but stamp duty and all the other bits and pieces, which is typically about 6%. 106%. We want to put that debt against our equity over here. That's our investment deposit. And so whilst we've used the equity in our home, that loan facility is for the investment property. And when it comes tax time, when we're claiming against the rental income that we've got, we can claim the interest on this debt and we can claim the interest on this debt as well, because they're all investments for this property. So that's a great way to spread the load a little bit, avoid mortgage insurance, and still allow you to increase your investment portfolio or to put a deposit towards the next property when the time is right. There are a few key costs that we want to account for when we're looking at a refinance, especially if we're looking at debt consolidation or just moving a loan to another lender, putting accessing equity for a purchase aside for a second. The main thing that everybody is aware of is that if you put the same debt over a longer period of time, you're going to pay more interest. Even if the interest rate is a little bit lower, you've got the debt for a longer period of time, you're paying it down faster, and so you're going to pay more interest in the long run. We put that to the side for a second as well, because things can happen over time. Maybe this is just a tough period in life where you need a bit of extra cash flow and you know that things are going to change soon. You can play a little bit of catch up later. Maybe it's just one of those things where you might need to sell in a few years. Lots of things happen in life. 30 years is a very long time, right? The main thing we look at is the benefit or the cost of refinancing in the moment. And so what we're talking about here is the interest. Are we saving interest because we're going to a lower rate? Are we paying interest because we're going to a higher rate? Are we paying fees to move? Are we saving by moving? And so we've got a bit of a table that we use. This is just a really basic version of it, but I'll show you the example. But first of all, we'll go back to our example before of the $450,000 loan. 6.5%, current rate, 6.14% that we're moving to. And you can see that every single month, the interest that we're saving is about $130, $135, right? And so over 12 months, over a year, we're looking at about $1,600 that we're going to save. Now, yes, I have different terms in here, but you can see that if I change the term, that doesn't actually change the interest calculations because it's only interest on the balance. It's not amortizing and paying the debt down over a certain period of time. So the interest here is correct. Now, if we look at this little example of our comparison, current loan amounts of $450, current versus new rate. Some banks will have annual charges for different features and some won't, so we need to take that into consideration. But when we're moving, we have to pay government charges to change the name of the title, name of the lender on your title. So you might be with ANZ and moving to CommBank, and so the government will remove ANZ from your title and add CommBank, and there's a charge for the discharge and the registration of each of those lenders. You're going to have an exit fee, a discharge fee from ANZ, around $300 to $400. You're going to have a couple of fees at the new bank, CommBank. This is all banks, I'm just using the names as an example. But overall, you're looking at about $800 to $1,200 worth of fees. And so, if we say roughly $1,000 in the middle there, our first year of savings, whilst we're saving $1,620 in interest, we're paying $1,000 in fees to move. So realistically, our first year's benefit is only $620, but we're going to save more as we move on. Now, as I said, this is quite a rudimentary example of the calculations. It doesn't take into account the amortization of the loan or anything like that, but it gives you an idea of what we're looking at. Is there a net benefit to move? Because there are costs to move. Government charges, outgoing lender, incoming lender. Maybe we've got a new annual fee with the new lender. Maybe we have an annual fee with the current lender and no annual fee with the new lender. There's lots of little things that we want to factor in and make sure that there is still a benefit to refinancing, apart from obviously the cash flow side of things that we spoke about before. Like, are we just saving on cash flow, or are we actually benefiting ourselves in terms of the cost, the fees and the interest charges on that debt? I'm a little bit biased, obviously, being a mortgage broker myself, but there are so many benefits for using a broker, because every bank, every lender has a little bit of a different offering. To give you some examples, banks will have different policies when they're assessing income or assessing expenses, which means the lender that you're with now might not be taking as much of your overtime or commission payments or your business's income as another bank will. And so it limits how much you're allowed to borrow, to consolidate debts, to access equity for an investment property. Different banks will also have what we call loyalty tax. So quite often banks will give you a discount on your interest rate, and that discount will stay in place for the life of the loan. But then in 6 months time, they'll offer new clients an even bigger discount. And so over time, your interest rate looks much higher than new clients because your discount was smaller. So you're paying a loyalty tax for staying with it. Some banks will actually ensure that all clients across the board, new, old, as long as you're in the same loan amount and loan to value ratio bracket, you have the same interest rate. So that's really important for some people to know that they're on the best deal. They don't need to keep shopping around because they've got something that works, and they don't need to keep an eye on it. They don't need to monitor it, even though that's what we will do for our clients. So that can help. But like I said, some people want to stay with a bigger bank, and so we'll keep an eye on things for them and make sure that they're still on a good deal, or see if the benefits outweigh the costs when we're looking at refinancing or moving to a different lender. Now, outside of loyalty tax, outside of policies, we've got different features that we need to consider as well. We've got offset accounts. Does your lender offer one? Does it offer multiple? Does your lender charge a different amount for the offset accounts? Does it charge per offset account or one lump fee that covers you for as many as you like? Do you have unlimited redraw? Do you have online access? Do you have branch access? There are all these different features for loans that are really important to consider and make sure that it is the right thing for you. And that's where a broker will obviously step in. But the last point that I think is really, really important, especially when we're looking at refinancing and accessing equity for a new purchase in particular, is valuation results. If you were to speak to a few different banks on your own and you'd have a credit report inquiry noted against you, every single inquiry that you make with those lenders, you will find out when having your property valued by different banks that you get different results, but you've had credit hits due to that. Whereas with a broker, we can get valuations ordered up front. We don't have to hit your credit to have that done. We're not lodging any inquiries with the bank. We're just getting valuations done to find out what they think your property is worth and what equity is available before we go ahead and say this is the right decision for you. This lender is right because higher valuation, more offset accounts available, they allow more of your business income to be used and let you borrow more money for the investment. Whatever the reason may be, we present the options and the reasons to you based on what you have said your needs and goals are. But just to give you an example of the valuation differences that we can see, I've got here, we can see that the same property as before, we've got 3 very different results. The current bank that we're with has offered $800,000 as we've seen, which is great. We know that we can access $190,000 of our equity before we start to pay mortgage insurance. We know what we've got to work with. But next bank that we're looking to move to, they have fantastic features. Everything looks really, really good. It's a lower interest rate, but the valuation is lower, which means we aren't allowed to access as much as we had previously wanted. So now we've only got access to $150,000. And that $40,000 can make a big difference. And then we've got Bank C. Maybe they're perfect, or maybe they don't have all the features, or maybe they've got a little bit of a higher interest rate, but they've given us a much higher valuation, which allows us to access a lot more money from that property. So quick maths. Yeah, $230,000 that we can get as opposed to $190,000. And so you can see the valuation plays a huge part in deciding what we need to do. Maybe it's not about refinancing for rates. Maybe it's about making sure that we can purchase the next property, making sure that this investment is viable. And so a valuation is going to play a huge part in that to allow us access to more equity. So this is just a brief example of why the brokers in your life are so important. And if you don't have one, find one. Obviously, I would love to have a chat with you, but brokers in general are just so important. I've got a link to my calendar below. Feel free to book any time that suits you best, or reach out via phone or email. I'll always reply to people within a day, and I've got my phone on me all day long as well. But hopefully this video has helped explain the refinancing process, explain why we look at refinancing and the benefits, their costs, and how it can be beneficial to clients, either in the short term for cash flow or long term to reduce the interest charges or build their investment portfolio. Thanks for watching.